Good morning, everybody. I want to welcome you to the Levy Economics Institute and to the 31st Annual Conference. The conference is co-sponsored with our graduate programs in economic theory and policy. And since 2014, our graduate MA and MS programs have been preparing students to enter the policy analysis field by giving them alternatives to mainstream approaches to economics and finance. Featuring high faculty-to-student ratios, our students learn from Levy scholars past and present, as the work of Hyman Minsky, Wynne Godley, and others is part of the core curriculum. They go on to apply what they learn to work in the policy space, from federal, state, local government to public policy think tanks. Those in attendance who may be interested in graduate studies can get more details from our website. There are still spaces for this fall for both the one-year MA and two-year MS degrees. I hope the online nature of the conference will not affect the importance of the speakers' perspectives on the four important economic issues to be analyzed and discussed. Aside from discussing what is in store for the US economy this year and next, the remaining three sessions will explore the economic repercussions, first, of the government's green subsidies and other supply interventions, which Treasury Secretary Whalen called them a modern supply-side approach. President Biden's three initiatives, the Inflation Reduction Act, the Infrastructure Investment and Jobs Act, and the CHIPS and Science Act, appear as a revival of industrial policy. In the next session, we will focus on various aspects of America's state of inequality, considering the causes, measurements, and remedies, while in the last session, we will discuss the mythical problem with America's aging and public policy solutions. Almost all economic variables measuring the performance of the US economy, as for instance, the accelerated GDP growth and employment, saw a strong recovery, one of the fastest recoveries of the recent past. Consumption and investment, as well as easing supply chain problems, are fueling the US economy despite the Fed's high interest rates. Inflation in the US appears sticky, and the Fed is in no hurry for a rate cut in the second half of the year, despite overwhelming market expectations. To the contrary, minority voices in the Fed, such as those of Governor Michelle Bowman, and economists aligned with Larry Summers' views, consider a possible rate cut a huge mistake and would prefer another rate hike instead. The wrong-headed tight monetary policy of the Federal Reserve to curtail inflation and ease inflation expectations, especially when from their own research they admit they have no theory of inflation, is dangerous. It is a policy of flying blind based on hope. Some omens in the horizon aren't encouraging, and continuing the high interest rates longer will undoubtedly extinguish the possibility of a short landing, if such possibility ever existed. There are serious economic issues relating absolutely to high interest rates, affecting valuations of commercial and multifamily buildings and bank exposure to them, as you will hear from Christopher Whalen from in the next session. High mortgage interest rates and the effects on housing, especially affordable housing, equity and bond market high volatility, and the associated risks do not bode well for the U.S. economy, while servicing dollar-denominated debt in the developing world has strained government budgets. Some of these issues will be discussed in the session that will follow. The Levy Institute's views on the prospects of the U.S. economy are supported by the projections of our macroeconometric stock flow consistent model, which will be presented and discussed by the Institute's senior scholar, Gennaro Zezza. The analysis reviews prevailing conditions, assesses the behavior of drivers of growth and decline, considers the likely paths of fiscal policy, net exports and private sector expenditures, and the geopolitical challenges facing the U.S. economy. Moving on to the other sessions, we will discuss three other important, timely, and related issues. President Biden's modern supply approach aims at creating self-sufficiency, supporting technical training, green infrastructure projects, and other government programs directed toward the greening of the economy. The president's economic growth strategy is a new way of introducing industrial policy. Europe and other countries followed suit by implementing programs which many viewed as industrial policy, and a plethora of academic papers discussing the revival of industrial policy appeared in books and economic journals. There are advocates and champions of industrial policy, as well as those who insist that industrial policy is always successful in theory than in practice. They argue that governments are simply incapable of picking winners and losers or allocating efficiently scarce resources better than the market. And there are also the skeptics, suggesting that industrial policy is a good idea but cannot be successful in the US, as it will be explained in our session, and it as successful as it has been in China and the Asian tigers. The panelists in this session will present different views on the issue, which I hope will provide the opportunity for even other approaches to be articulated in the Q&A period. The panel of the third session will confront the continuing problems of America's inequality, affecting disproportionately the vulnerable segments of our population, such as the aged, minorities, and single-headed households. Different metrics of measuring well-being, inequality in time, and income poverty, developed by the Levy Institute over a period of many years, show how important the government support programs are, as are the contributions of household production. In the last session, the perennial myth of the unaffordability of the Social Security system will be analyzed and placed in the proper framework of the government's expenditures. The congressional theater on the debt ceiling, played always badly, never misses the opportunity, especially from the neoconservative wing, to attack the sustainability of Social Security due to supposedly lack of sufficiency in its trust funds. It is like the aged are viewed as a tax burden, and the trivial solutions proposed are a combination of increasing the retirement age together with cutting benefits. Private pensions have their own challenges, and these will be detailed, as will be solutions for moving forward. The speakers chosen for each of the four issue-focused panels are well-known economic researchers. Their views will enhance our understanding of the challenges ahead and the policies required to address them. I want to thank all the panelists and the moderators for their willingness to participate and share their views. And of course, the staff of the Institute, Michael Stevens, Emily Ongvari, and Lindsay Carter. I hope you will enjoy the presentations and discussions that follow. Your comments and suggestions are always welcome, and I want to thank you very, very much for attending. And now, if I may ask Harriet Torry from the Wall Street Journal to begin the next session on the prospects of the U.S. economy. Thank you very much.
Thank you. Good morning, everybody, and welcome to session one. We're going to be talking about the economic prospects for the U.S. economy, and we have a great panel. Just to introduce myself, my name is Harriet Torry, and I am an economics reporter with the Wall Street Journal. And the way that the session is going to run is each of our presenters are going to give a 20-minute presentation, and then at the end, we'll have about half an hour for a Q&A. So any questions that you have, feel free to put them in the chat, and we'll try and get to everyone's questions during the Q&A session. So the first panelist that we have this morning needs no introduction, I'm sure, to everybody on this call. It's Jan Hatzius. He's the chief economist at Goldman Sachs, and we look forward very much to hearing your thoughts on the economic prospects for the U.S. economy.
Thanks so much. Sorry, here I am. So I will share my screen in order to talk about my outlook on the economy. Let me go to slideshow setting. Awesome. So thanks very much to the Levy Institute for having me, and thank you, Harriet, for that very kind introduction. I'm going to spend about 20 minutes going through my views on the global economy and particularly the US economy, and we're definitely in the optimistic camp. We think that global growth is likely to come in again above consensus expectations in 2024, as it did in 2023, as well as 2025. We're looking for 2.8% for global GDP growth. This is on a market exchange rate basis, so these numbers are somewhat lower by about 0.5 percentage point than what you would get if you aggregated the different global economies on a purchasing power parity adjusted basis, which is the convention, especially for the international organizations such as the IMF or the OECD. If you look at the individual countries, we're in most cases a little bit above consensus for the euro area, for the UK, for Canada, for Australia. The place where we are most clearly above consensus, especially if you take 2024 and 2025 together among the advanced economies, is the US, about 0.5 percentage point above. And that's a long-standing difference between our view and the consensus view. Here I show how the 2024 GDP growth forecast and the 2025 GDP growth forecast have evolved for our numbers and for the Bloomberg consensus. And we think there's still additional upside for the consensus views by approximately 0.5 percentage point in both this year and next year. Now, why is the economy growing so strongly? One popular view is that a lot of the strength is driven by fiscal expansion. And it's certainly true that the US has been running a large deficit, a large structural deficit for a number of years. This is a very simple way of illustrating that there has been a large structural deficit. I'm simply plotting the budget balance, federal budget balance, against the unemployment rate. And as you can see, the deficit is much larger than you would have expected it to be on the basis of where the unemployment rate stands relative to past cycles. This may be the simplest way of illustrating that the budget imbalance is structural, and that, of course, at some level is expansionary. With that said, our estimates suggest that the impulse to growth from fiscal policy in 2023, 2024 is actually quite small. That the deficit is large, but the impulse to growth really depends more on the change in the deficit and the change in the deficit and the lagged effects of past changes in the deficit, and that impulse is, by our estimates, quite small. Fiscal policy was very expansionary, had a very large positive impact on growth in 2020, 2021. It had a meaningful negative impact on growth in 2022, but now we are closer to zero in terms of the impact. So what are the drivers of strong growth? I would say on the demand side, the biggest two drivers are strength in real disposable personal income, and that you can see that on the left-hand side. The blue line here is real disposable personal income, which grew over 4% in 2023. We think in 2024 we're likely to see something more moderate, but still to the tune of 2.5% growth in real disposable income. The right-hand side illustrates that the main driver of the strength in real disposable personal income growth is really the growth in hourly real wages, as the deceleration in nominal wage growth has been small relative to the very large deceleration in headline inflation. So that's driver one. Driver two of the strength of growth is that financial conditions have gone from being a very large negative on the growth pace in 2022, early 2023, to now being positive on GDP growth. The left-hand side shows our financial conditions index, which is a weighted average of short-term interest rates, long-term interest rates, equity prices, credit spreads, and the dollar, with weights that denote the impact of shocks to each of these variables on real GDP growth in the subsequent year. The right-hand side translates the past shocks to financial conditions into an impulse to growth in each quarter, and we have gone from about -2 percentage points of growth impulse in the fourth quarter of 2022 to an expectation, if financial conditions stay where they are, that financial conditions will contribute about +0.25 to +0.5 percentage point to growth over the next year. So a lot of support on the demand side for strength in growth. Nevertheless, we have been and remain optimistic that we are going to be able to bring inflation back down to roughly the Fed's 2% target by the end of 2025. Despite our optimism on the growth side, we're also pretty optimistic on inflation. And I'd also emphasize just how much progress we've already made on bringing inflation back down, despite the recent upside surprises in the month-on-month CPI and PCE inflation numbers in the first quarter. On a year-on-year basis, core PCE inflation, maybe the most important measure from the Fed's perspective, stands at 2.8%, down from nearly 6% at the peak in early 2022. Now, how can we have such progress on inflation despite the strength of demand and the strength of growth? The reason, in our view, is that supply has grown even more than demand. And this is partly strength in productivity growth, where the recent numbers, despite this morning's slightly softer number, have been quite encouraging, and where we are now a little bit above the long-term trend of about 1.5% that's really been in place since before the GFC back in 2007, 2008. This, I would note, is still before we are likely to see a significant impact from generative artificial intelligence. We think Gen AI is likely to have a large positive impact on productivity growth, but we're pretty sure that this is still a number of years down the road. We're penciling in 2027 or 2028 for that macro impact to really start. But the productivity is already doing pretty well even before a meaningful impact from Gen AI. And the other big driver of supply side of aggregate supply really has been the strength in labor supply. We've seen a big increase in the labor force participation rate from very depressed levels in 2020 at the height of the pandemic. That has boosted labor force growth sharply. And then over the last year, we've seen this very large increase in immigration, which is also boosting labor force growth sharply. Our estimate is that 2023 saw about 2.5 million immigrants on net. That's not quite as high an estimate as the 3.3 million estimated by the Congressional Budget Office, but it has been very substantial nonetheless. And the best way to really see the importance of the increase in labor supply is to look at what's happened to non-farm payrolls versus what's happened to non-farm payrolls versus the unemployment rate. We've had nearly 250,000 new jobs per month in the last 12 months. Nevertheless, the unemployment rate has been going sideways to slightly higher. That's evidence that the break-even pace of payroll growth is much higher than it was pre-pandemic. And these factors really have been the driver, especially immigration in recent months over the last year. Now, how do we know that supply has grown by more than demand? How can we really check? I think the way to check is to look at measures of labor market balance or labor market imbalance, and these, I think, show provide a clear signal that supply has grown faster than demand. Whether you look at the unemployment rate, which has edged up a little bit, or broader measures of labor market tightness, such as the quits rate, the differential between respondents saying jobs are plentiful versus hard to get, the percentage of firms in the small business NFIB survey that say that they have positions they're not able to fill, or what we call the jobs workers gap, the difference between job openings and unemployed workers. All of them are showing a loosening of the labor market despite the strength in demand growth and the strength in GDP growth that we've seen over the last couple of years. So to me, that is a clear sign that supply is growing faster than demand. And if we take an average of how these different measures have evolved, we're now basically back to the levels that we were at in February 2020, a strong labor market, but no longer a significantly overheated labor market. We can also see, I think, a significant amount of progress if we look at wage growth. Wages were growing at about 5.5% or nearly 6% in early 2022. We have come down to a little over 4% on nominal wage growth, and more leading indicators of nominal wage growth, such as business surveys that we translate into our wage survey tracker, or the so-called Indeed wage tracker, which looks at posted wages and job ads, suggests that there is additional downside for nominal wage growth and that we will get back to something in the 3.5% range before too long. And that is indeed our forecast. I think there are three other reasons for why I am optimistic that inflation can come back down to the Fed's 2% target. Number one, I think there are still good reasons to believe that core goods inflation will remain low and maybe actually fall a bit more in the near term at least. And this is because in a lot of core goods areas, prices are still at very high levels relative to the pre-pandemic trend, even though conditions in those core goods markets have already to a large extent normalized. A good example is used car prices, where the official CPI numbers are still well above the levels that you see in other measures, such as auction prices, as you can see on the right-hand side, and I expect significant additional downside in some of those areas. Second additional reason beyond the basic supply-demand analysis to expect decelerating inflation is that I think there's still a substantial amount of downside in the CPI and PCE measures of rent and owner's equivalent rent inflation, which badly lag the conditions in the for new leases in the rental market. This chart simply shows an average of leading housing price indicators, or rather rent price indicators, and plots that against the official housing measure in the PCE index. And the lags are long, and there is still a significant amount of downside. Lastly, and this is, of course, very important for central bankers, inflation expectations have come back down to levels that are consistent with 2% PCE inflation. I should say short-term inflation expectations have come back down to about to levels consistent with 2% inflation. Long-term inflation expectations have been consistent with 2% PCE inflation all along throughout this entire episode. So to us, this still says that the next move in the federal funds rate is very likely to be lower. And I was heartened and encouraged by Chair Powell's press conference yesterday, where he pushed back very strongly against the idea that rate hikes might be on the table in the remainder of 2024. Our baseline expectation is that we get a couple of cuts in 2024. Admittedly, we have several times already pushed back the start of the rate cuts and are now at the July meeting, basically on the back of these higher than expected inflation numbers in the first quarter, which have wrong-footed us, but haven't really done much to make us doubt the basic narrative that inflation is on its way down and the Fed is ultimately going to respond to declining inflation by cutting interest rates. And as you can see on the right-hand side, our view is slightly below market pricing in terms of where the funds rate is likely to go. I want to talk just briefly before I close, and I am conscious of time, but just want to talk briefly about the election and what the economic implications of the election might be. It is too close to call who is going to win. If you look at betting markets, the probabilities are somewhere around 50-50. If you look at national polls, the vote shares between Biden and Trump are pretty close to 50-50. Trump still has a modest advantage if you focus on the Electoral College, because he still seems to be doing somewhat better in the swing states, and especially in the most likely tipping point states, than nationally. But of course, there's still a long way to go, so it is difficult to know who is going to end up winning. I do think that the biggest question in the event of a Trump victory is going to be what happens to tariffs. Trump has threatened significant tariff increases at 10% surcharge on all US goods imports, as well as a 60% tariff on goods imported from China. If you look at the right-hand side of this chart, you can see that this 60% tariff on goods imports from China on its own would imply an increase in the effective overall US tariff rate of about 8 percentage points. So based on these threats, we have looked at the potential impact of an increase in the tariff, in the overall US tariff rate of 10 percentage points. What does that do to potentially to inflation and growth? Where we come out is that on inflation, we would expect an increase in the price level of something like 1 percentage point or so. To take the core PCE price index and look at the experience of the first Trump administration and basically scale that up accordingly, we get about a 1 percentage point impact on the core PCE price level. On the growth side, I think it is quite a bit more uncertain, but because you also have to make assumptions about whether these tariff increases would be recycled into tax cuts, the revenue associated with that, which would be as much as potentially $300 billion a year, whether that would be recycled into tax cuts, and whether other nations retaliate. If you assume that there will be tax cuts and we get full retaliation, we estimate a negative impact on growth worth about 0.7 percentage point. But I would emphasize that the uncertainty around the growth impact is significantly larger than the uncertainty around the inflation impact. The other question after the election is really what happens to the tax cuts that expire at the end of 2025. These are the personal tax cuts passed in 2017. That expiration is worth about 1.5% of GDP. So Congress will have to do something under any election outcome. And we expect that most of these tax cuts probably would be extended. That's true, I think, basically entirely if Republicans take control and Trump becomes president. It's probably still mostly true if Biden wins another term, because there has been a signal that taxes will only go up for households making more than $400,000 a year. So we probably will get an extension of these of most of these tax cuts. And then lastly, we have looked at different scenarios depending on who wins the presidential election and whether the winner of the presidential election will have unified control of Congress, and then made assumptions about the impact on overall fiscal policy in 2025 through 2029. And what we come up with is that a sweep by either side would likely be more fiscally expansionary than divided government. Let me pause there and turn it back to Harriet.
Great. Thank you so much, Jan, for that interesting presentation. And I see that we also have some questions already in the chat, but we're going to hold off on those until all of the moderators have given their presentation. So let's move on now to our next presenter, Christopher Whalen. He is the chairman of Whalen Global Advisors and also writes the Institutional Risk Analyst newsletter. So we look forward to hearing your thoughts on the prospects for the economy, the US economy.
Hello, this is Chris Whalen. Can you all see me?
We can, thank you.
Excellent. I'm going to share my screen. All right, so good morning, everyone, and it's a pleasure to be with you. My name is Christopher Whalen. I'm an investment banker and historian that occasionally masquerades as an economist. I have written a good bit about economic history. And in fact, I'm reissuing my book Inflated because it seems to finally be topical. Let me start off, since Jan gave us such a good presentation regarding the economy, to put an idea in all of your heads, which is it's only when you focus on the commercial real estate sector and the history of commercial real estate in the United States over the past century and more that you understand why the Fed says that 2% inflation equals price stability. Why do I say this? Because the assets in the commercial real estate market have essentially been appreciating for the last 100 years. I say this as someone who is a specialist in banks and who has rated dozens, if not hundreds, of banks during my experience in the world of bank ratings. I was head of research and corporate and bank ratings at Kroll Bond Ratings for a few years. And what I discovered is that most of the banks I rated that had commercial real estate or multifamily assets on their balance sheets basically had never seen any appreciable default activity on these assets. That is to say, the price had already gone up, always gone up, excuse me. What we're seeing today, and I'm going to talk about why we're seeing this, is a complete change in direction in the value of commercial real estate assets. And if you understand what that means, and I'm going to walk you through it in some detail, then you understand why I say that we need some inflation. In fact, I would say to Jan, maybe we need to have higher than 2% inflation. Because if we don't, then what we're going to see is a repricing and to some extent a liquidation in commercial real estates that I think is going to take many people aback. The decline in commercial real estate valuations are driven by many factors. Interest rates is obviously an important one, but equally important is the change in behavior by consumers, by businesses, and the way in which they manage their employees, their businesses, and all of the aspects that come into play there. Even though we have seen some commercial real estate assets cut in half or more, that's not always the case. You cannot generalize about commercial real estate. One of the things I learned when I was working at Kroll Bond Ratings was that residential real estate, you can generalize. The assets are similar, they're fungible, and there's many ways in which you can look at portfolios of residential real estate. You cannot do that with commercial. Commercial is what we call chopped salad in the world of analytics. Every month, every year, every cohort, that's in a commercial mortgage-backed security, for example, are all different. And so as a result, getting your hands around what's going on in this sector is extremely hard. But having said all of that, what we have is an asset class that's about $20 trillion that is held by banks, by real estate investment trusts or REITs, and are also held by bond investors in the bond market. So let me go to the next slide. All right. The MBA is a great resource in general for commercial real estate. There are some very specialized firms out there that gather price data and tax data, and rent rolls, and everything else that you need to assess a commercial property. But in the most recent survey, what the Mortgage Bankers Association have told us is about 90% of their respondents have a negative attitude regarding commercial real estate. What does that mean? Well, what it means is that when my clients, who are large institutional investors, look at a commercial property, what's the first thing that they assume? They assume that half of the tenants are going to leave or downsize in the next 12 months. That is a rather striking change from the pre-COVID period, when we saw basically people looking at commercial assets as one of the safest sorts of investments out there. You saw pensions, sovereign wealth funds, everyone really flying into commercial real estate before and during COVID and immediately after COVID, because they saw it as a safe place to put their money. But that is not the case. At the same time, we have a very interesting subset of the commercial real estate market known as multifamily. These are apartment buildings. Apartment buildings, I'm sitting in New York, by the way, in a building right on Central Park that's about half empty. The building is still generating enough cash flow to pay its bills, but obviously, if it's only half filled, it's not fully utilized. And in fact, most of Midtown Manhattan, from 59th Street down to 34th Street, we're probably looking at less than 50% utilization on average for all of those assets. That's a striking turnabout from where we were, say, 10 years ago. More importantly, the multifamily assets in this equation are not just affected by interest rates, they're also affected by what happens to investor expectations when interest rates rise. Investors expect higher returns. So what that does is it tends to push down the value of the asset, all things being equal. We'll get into the math involved in this in just a second. The final part, of course, is politics. You've seen some states around the country, particularly New York and California, but others as well, embrace rent control and other types of supposedly pro-consumer policies, which are actually hurting consumers because they are reducing the amount of rent-stabilized and rent-controlled apartments in cities like New York. New York City has almost 400,000 public housing units. This is the great monument to the progressive legacy of people like Robert Moses and others. But today, those housing assets are extremely expensive, and the city of New York is probably not well placed to run that portfolio, but it is what it is. So let's go on to the next slide. This is interest rates. I'm going to skip this for a minute. When you look at commercial real estate, one of the things that you have to realize is that this is a largely institutional market. And as I said before, coming up on 2019, when the Fed dropped interest rates rather dramatically, the commercial real estate market was a large, almost entirely institutional market where you had big developers managing and building new assets, and they really didn't worry about price. They assumed that prices were always rising. And for this reason, it became very common in the commercial real estate world to do interest-only financing on these assets, because every 7 years, the mortgage would mature, the owner would take a little cash out, they would roll the mortgage, and off they would go. The valuation always went up. And as you can see in this chart from Fred, at the beginning of 2020, there was a vast uptick in pricing for commercial real estate. And it was, in fact, a bubble. What's it doing now? It's going down. And it's going down rather dramatically. But you know, the misallocation of resources that occurred during COVID, when everybody was frightened didn't know what was going to happen next. And you had a lot of very large players around the world who all saw commercial real estate as a safe place to hide. Well, they were unfortunately mistaken. The big thing I would put in front of you is that when you think about commercial real estate, when we get to the point where prices are going down, the entire complex built around those assets starts to deteriorate. Let me give you an example. New York Community Bank, which is a bank I've followed for many years, just reported earnings. And what they've told you is two very important things. Number one, a lot of their borrowers who have multifamily apartment buildings are under stress. At the same time, those buildings are fully let. So the building is generating cash flow. The problem is the building's valuation has probably been cut in half, largely because of political factors here in New York. This is a striking turnabout, and it's a turnabout that the system really is not equipped to handle. Even if we saw the Fed cut interest rates tomorrow, let's imagine we saw 4 Fed fund rate cuts, so we got back down into the low 4s. It still might not impact commercial real estate because that market is priced off the longer end of the curve. 10 years, 7 years is typically the tenor for most commercial real estate loans. So what we have is a situation where idiosyncratic factors, monetary policy, and politics have all come into play, and they're all basically pushing down the value of these assets. Let me go to the next slide. This is probably the most striking slide I ever show my clients, and this comes from the FDIC. This is what we call loss given default, which is a fancy way of saying net defaults. This is the net loss after default. The red line is residential mortgages, almost $4 trillion worth of loans owned by US banks. These are prime mortgages predominantly. And as you can see, loss given default at the end of 2023 was 0. How do we have 0? Well, because if there is a default, and there aren't many, the house sale covers the entire balance of the loan. In fact, in some cases, they're generating a surplus after they pay off the note, and the lender, whoever foreclosed on the note, ends up retaining the surplus. On the other hand, that blue line is multifamily apartments owned by banks. It's about a $400+ billion portfolio. And as you can see, loss given default is almost 100%. These are fully secured loans. These are mortgages. And yet the banks are losing almost the entire face amount of the loss of the loan. This is an average, keep in mind. It is possible for a multifamily lender to lose more than 100% of the face amount of the loan. Why? Let's say the building goes into foreclosure, the bank ends up as the owner. The original owner, quote unquote, has walked away. The city of New York's not going to let the bank walk away from that building. They're going to make the bank take care of that building until they find another owner. An extreme example of this you can see from Signature Bank. Signature Bank's assets were basically unsaleable, the rent stabilized assets. So the FDIC has essentially decided to retain the majority stake in all of those buildings inside the bank insurance fund. This is Marty Grunberg's legacy, I think, once he leaves as chairman. Eventually, those assets will have to be sold. But the market is so bad today that the FDIC didn't even want to try. Let's go to the next slide. One of the striking things, again, the dichotomy between the residential market and the commercial market is that you can look at a series like construction and development loans. This is a $500 billion portfolio of both residential and commercial. On average, they're losing almost 100%. That's bad. These are fully secured loans that have property behind them, right? So let's go down now to the next slide. Let me just skip over this. I want to go down and show you. Oh, sorry. But let me go back actually. The reason I wanted to focus on this was if I just focus on residential loans for construction and development, the loss given default is almost 0. It's very similar to what we see going on residential loans generally. So on the one hand, banks are seeing significant losses coming from construction and development loans on commercial properties, but they're not seeing that on residential at all. In fact, quite the opposite. What is going on in the background with commercial property is what I call the deflationary math of capitalization rates. The capitalization rate is essentially a way of an investor assessing the value of a building by looking at the net operating income that the building throws off versus the ostensive valuation or the purchase price of the building. When interest rates go up, cap rates go up because investors expect that they're going to get a higher return. But if you do that and the net operating income of the bank doesn't go up as well, what happens? The value of the asset goes down. So unlike pre-COVID, when you had very stable valuations for these assets, today nobody knows. If you have a professional looking at a building, say here in New York City today, they don't know. The first thing they're going to do is walk in the building with an assumption of anywhere from a 20 to a 30% discount from the last valuation. So let me show you what this means. In 2020, you had a New York City apartment building, had $1 million in net operating income and a cap rate of 4%, resulting in a value of $25 million, okay? The owner has a $14 million mortgage with a local bank. In 2022, the net operating income of the building falls to only $500,000. Why? Because we had 2 years of rent moratoria during COVID. You never heard any members of Congress worrying about landlords, did you? Well, landlords don't have secret pots of money hidden in the closet for things like loan forbearance or rent moratoria. And so that entire class of small and mid-sized developers that owned these buildings basically lost money for 2 years. So here we are today. The building's value has been cut in half. It's now only $12.5 million. Still at a 4% cap rate, right? We're lucky. But the bank now has a loan that's underwater. And they've notified the owner that when the loan comes up due, they're going to have to put more cash in. But in the meantime, the bank extends the loan on existing terms. This is what we call a modification. This is very common both in the residential mortgage industry and the commercial mortgage industry. What this means is that the borrower is impaired, the asset is impaired, but we're going to pretend that everything is fine. Finally, we get to last year. Cap rates have risen along with interest rates. The building still has $500,000 in net operating income. It hasn't recovered to where it was, but now the value falls to $6 million because of the expectations by the bank, interest rates, etc. That the credit is going to be more expensive. That's how we are dealing with commercial real estate today. So project this onto the country, project this onto big cities that have progressive governments that think that they can legislate economic outcomes and that they can ignore inflation. And this is kind of where we are. I think that one of the best ways to understand this is to realize that inflation is a constant in all real estate markets in the US. It's why real estate has been an inflation hedge. But when we get periods of deflation, either because of interest rate movements, which is what people normally anticipate, or because of idiosyncratic changes in behavior, in politics, and other factors that all come together, you end up with a very bad situation. To say that real estate prices have been, commercial real estate prices have been inflated since the great financial crisis, I think surprises some people, but it is the reality. So how are we doing on time, Harriet?
We are, well, it would be great to wrap up so we can get to the discussion on time.
Yeah. Let me just leave you with this last slide. I left the residential slides in the back of my deck. If you have any questions, reach out. But, this is what's going on with delinquency right now in commercial real estate. And again, this is an average. This is not an economic sector that's amenable to averaging. It really is not. There are publications like The Real Deal New York that track the commercial real estate market in gruesome detail. if you just page through their headlines, you're going to see that there's 50% plus discounts on commercial assets. Downtown Los Angeles, a wasteland. You can't even sell those assets right now. And this is not just blue states. If you go to Cincinnati or Dallas or any of the other legacy cities, you're going to see the same thing. So let me leave it there, and I look forward to the questions. Thank you.
Thank you so much, Christopher. That was a really interesting overview of the situation in commercial real estate. And we're now going to hand over to our final presenter, Gennaro Zezza, who is an economist at the University of Cassino in Italy. So please, we're looking forward to hearing your thoughts on the economic prospects for the US.
Thank you so much. Let me share my screen. Okay, I hope you can see it. I'm going to present the work we do at the Levy Institute together with my colleagues Dimitri Papadimitriou and Giuliano Giagima. And my talk will partly overlap with Hatzius, although we have a slightly more pessimistic outlook on what's going to happen to the US economy. So we usually start by looking at what the Congressional Budget Office is projecting, mainly to have an independent view on fiscal policy, on the determinants of growth. And we start from here. What I noticed, first of all, is the volatility of predictions in the last months. So the CBO was projecting GDP growth in 24 to be 1.5% in February. The number had risen to 1.8% in March. And if we look at other institutions, so the IMF has in April 2.7%, and the OECD is on a similar line at 2.6%. Now, we believe in the growth model proposed by Wynne Godley in his new so-called New Cambridge tradition, which, following the Keynesian lines, has demand as the main determinant of growth. And this is quite at odds with the approach followed by other institutions. For instance, the CBO is quite clear in saying that the development of supply is more relevant, at least in the medium term. And I was very much interested in the presentation by Hatzius, which compared supply and demand. And I was a little puzzled by his projection of a strong growth in supply, which is a little at odds with our figures for what's happening in the US, because he mentioned the strong growth in the labor market, but actually the labor force over the working age population has been growing quite strongly, but is still quite below where it was before COVID, and even more below where it was before. And also, if you look at the utilization rate, this has been falling in the last 2 years. So again, unless there's been a very strong increase in the stock of capital, this is not pointing to a very strong increase in supply and demand. Anyway, to go back to my own presentation, what we have noticed is that government expenditure has been a large component of the growth determinants. We view consumption and investment as mainly being driven by external autonomous sources of demand. And therefore, we always look at the behavior of net exports and fiscal policy first. And then we know that consumption and investment can get additional boosts from capital gains, etc. But this has to have to be financed. So we look at the sources of finance and the sustainability of finance. So looking at residential investment, according to the CBO detailed projection released in February, the reason for a sustained growth is mainly coming from residential investment, as I had in my first slide, that the CBO projects to go to 5% this year and more than 10% in the coming years. And they attribute this mainly to the expected fall in the interest rate. Now, we are a little suspicious that the interest rate may have such a large effect on investment. It certainly has a large effect on the cost of a mortgage, but mortgages, which were surely a main driver of residential investment before the Great Recession, have now become less closely correlated to the behavior of real residential investment. And therefore, on this front, we do not see a potential boom in residential investment. But I will come back to this in a few minutes. The other potential source of credit-led consumption would be from the short-term loans. And again, these have risen relative to disposable income in recent times, but seem to be rather stable. So we don't see any reason to expect that consumption may increase above real disposable income because of loans. And corporate businesses seem to be deleveraging. So again, we do not expect a further boost to investment, also non-residential investment, coming from determinants which are not expected sales coming from existing sales. So we believe that the private expenditure would not increase substantially unless there are external stimulus. So we need to look at fiscal policy and monetary policy. Monetary policy has been already discussed. It's striking that the Fed is still keeping the real interest rate at such a high level. And we understand that the Fed does not believe that inflation has been solved, even though PCE inflation is going back to its target of 2%. And this should push for a quicker drop in interest rates. On the other hand, interest rates also have an impact on the income of those who lend. And the income of those who lend has been hit hard by all these years of very low interest rates. So there may be other reasons related to income distribution for keeping the interest rates high just a little longer. But I don't have any strong evidence about this. What evidence we have found instead, which is interesting, is that residential investment seems to be more strongly correlated to the behavior of the housing market. So here I have plotted the investment as percentage of disposable income on the one hand, and the capital gains on household real estates. And this is a measure that we derive from the revaluation account of which is part of the non-financial accounts of institutional sectors, related to the value of the stock of housing of the household sector. So basically, this is a more direct measure of how much an increase in the market price of homes translates into money into the pockets of the household sector. And this does not seem to have increased so much as the Case-Shiller index deflated by the consumption deflator. So if we look at these two lines, one as a measure of the returns on investment in the stock market, and the other one, the return on investment in the housing market, they both seem to suggest that we have a boom, but my figures for the household sector seem to suggest that this boom is not translating so much as more money into the pockets of household as it did in previous episodes of booms. This also suggests that things may be going well, but when the market prices go so high, they may also go down sooner or later, and therefore financial fragility should be expected from these two indices. Another important issue is the behavior of wages relative to prices, which was also discussed by Hatzius. And it is true that recently the average wages or the weekly pay of workers, even normal or non-managers, have risen substantially. So they have kept pace with inflation, but they do not seem to have grown so much to bring back the US labor share to where it used to be some time ago. So there may be still space for a push to demand coming from higher real wage. But again, I hope Hatzius is correct in thinking that this will materialize, but I don't see this into the data as so far. Now, the other external determinant of demand would be foreign net exports. And the balance of payment of the United States seem to be doing better than in the past, but is still very much in negative territory. And there are a number of problems related to the external trade of the US that you would know very well. The first one is that the dominance in durable goods has declined and does not seem to be recovering, even with the industrial policies I will briefly mention next. What has improved dramatically is the trade in oil products. And this has also been helped by the crisis with Russia that has certainly increased the exports of gas to Europe. But it is not sufficient to cover the deficit coming from other components of trade. And what is also interesting is that what we should expect, and what Godley also discussed at some length, is that when a country is running such a large current account deficit relative to GDP, it should be building up a large and growing foreign deficit. And this large and growing foreign deficit should imply large and growing interest payments made abroad. So Godley was well aware of the role of the US dollar, nevertheless suggested that an increase in interest payment made abroad would transfer purchasing power to foreigners and would therefore be a subtraction to the potential growth of domestic demand. But the US has this puzzle, which has been going on for a very, very long period, which is that, yes, the foreign debt is growing, but net foreign interest payments have not grown that much relative to GDP. This is also because of low interest rates, of course. But the other interesting part is that the income from capital has always been much larger. The inflow of income from capital has always been much larger than the outflow of interest payments. And this is still the case. So the income balance of the United States is still in positive territory against the expectations. So this is also relevant to the discussion of the role of public debt, which is an obsession for many economists and politicians. Now, I endorse the view that government debt for countries like the United States is not usually a problem unless it translates into a large foreign debt. And the reason why a large foreign debt would be would be a problem is what I just mentioned a few seconds ago, that it implies larger interest payments. So even this part is not relevant for the United States. So I really don't see reasons for worrying so much about the US federal debt, even in a global perspective. So what about industrial policy? There will be a session on industrial policy coming next. So I will just say a few words, also because my few words are mainly taken from an excellent piece that Jamie Galbraith wrote for INET. And since Jamie is in the next session, I think he will give more details about this. I will just mention that the bipartisan infrastructure law as so far being a boost to income and demand, but apparently its effects on supply and productivity will be limited. The Inflation Reduction Act may have some impact on the cost of energy, but is being discussed. It's not so clear that it has contributed substantially for the increase, for sustaining this real disposable income. And the CHIPS Act is also under discussion. Apparently, there are labs being built in California to start an import substitution process, but also a recent article in the New York Times was slightly skeptical on the effectiveness on this policy in terms of competitiveness and reduction on the dependence on foreign production for the US, although it is obviously relevant from the policy perspective. So coming finally to our own policy, our own baseline projections, for the reason given in my talk, we are more pessimistic than consensus and of Goldman Sachs. And if public expenditure will slow down, as in the CBO projections, we believe that this will imply a slowdown also in private expenditure, both for 24 and 25. Our model is more or less in line with the projection for inflation and the behavior of the interest rate. And I think that this will be enough. Maybe I was a little short on time, but I can recover in the Q&A session. And these are our main conclusions. We are a little more pessimistic, mainly because given our attention to demand, we don't see signs of sustained demand in the next 2 years with respect to the other institutions who produce these projections. And we think that fiscal policy will still be a major determinant. Thank you.
Thank you so much, Gennaro, for those thoughts. And now we're going to move on to the Q&A section of our session. So I see that quite a lot of people have put questions in the chat. I'm just going to start from the top. One of the first questions we have is interesting. Do we have a general coherent theory of inflation? My coherent theory of inflation is prices go up generally, sometimes more quickly than others, but I am not an economic expert. So does one of you want to give their thoughts on inflation and where it's headed?
I can just a few words. In my view, the cost push inflation theory is doing relatively well if you include, obviously, the cost of imported materials. The problem with inflation for economists is that it has been flat for so long that it's hard to explain something which remains flat. Now that it's moving up and down, we are doing much better at explaining inflation.
Hey, Harriet, this is Chris. What I would say about housing is that it's driven by demographics. Interest rates are important, but we are headed towards the end of this decade for another big reset. So Fed drops rates, volumes rise, we have a rally in housing prices, and then we're going to definitely see a reset. One of those episodic ones like the 90s or the 2010s.
That's great. Sorry, Jan, go ahead.
Yeah, look, I think there are demand factors and supply factors, and I would agree that the supply factors were dominant in this cycle, and I think there's still plenty of reason to expect more disinflation from the lagged effects of these supply disruptions that are working themselves out. We are also seeing downward pressure on wage growth, which I think still has a ways to go. That should also be disinflationary. And then there are a lot of lags in the way that the Bureau of Labor Statistics measures inflation, especially on housing. So, what happens later this decade on house prices and rents, that may well be that we see another increase. But in the near term, I think housing is going to be a disinflationary force in terms of measure of inflation.
Okay, Jan, and the next question I believe is for you. This is from Kamya. It's a question on productivity. Could you elaborate a little more on the analysis behind the optimistic view on productivity?
There's sort of two parts to it. One is just an observation that the productivity numbers, post-pandemic have come in relatively strong. We've been at sort of a 1.6% annual rate if we take the period since the fourth quarter of 2019. So I would say that's sort of modestly optimistic, or more a modestly positive observation on what's actually happened. On AI, the reason why we get some large productivity boosts from AI is basically that we think there is a lot of low-hanging fruit in terms of replacing low and mid-level type of desk work with AI. This is based on an analysis of the Labor Department's ONET database that breaks the economy and the labor market into 900 occupations, and then provides some pretty detailed information on what people in each of these 900 occupations do with their time, which then allows us to make some informed guesses, and it's no more than informed guesses at this point, how much of that total labor input can be replaced by AI, and we then basically translate that into some estimates. And we get about a 1.5 percentage point boost to annual labor productivity growth over a 10-year period from AI, which would be sort of similar to the impact from the internet or from electricity. So that's a very optimistic central view with a big range around it. So it could be even more powerful. We get numbers of up to 3 percentage points per year, but it could also be much less powerful, just depending on a lot of the parameters in the model. But 1.5 percentage points is the central case, and yeah, we will. So it's very optimistic, but at the same time, I'm quite sure that we're not seeing any of that in the data yet.
Gennaro and Christopher, would you have anything you'd like to add on productivity? I mean, it would be great if we saw a big spurt in productivity.
I agree with Hatzius, but the introduction of the internet take a long time to have any effects. And I think that Jan also mentioned this in his talk. So I expect the AI to have a similar impact. It will take some years before we see the effects on productivity, because people will have to learn how to use the AI. I'm using ChatGPT, for instance, and I spend more time discussing why it is wrong than getting quicker right answers to my questions.
Yeah, Yeah, Harriet, the one thing I would say is that banks are the biggest buyers of chips from NVIDIA, which they use for a variety of credit and operational processes. But I am still a big skeptic that we can really underwrite credit using AI. I would be short those stocks, let's put it that way.
The next question that we have is about wage growth. Do you see a reversion of wage growth due to the time during the pandemic where wages were raised to get or retain workers, and do you see more layoffs? I think this is a great question. I'd love to hear all of your thoughts on this.
Well, I'll go first. In housing, we are definitely normalizing after the COVID bubble. The housing industry increased headcount by 50%. In many cases, they hired people they had never met physically. And then we had the boom, and now we're normalizing. In fact, we're going to probably go below pre-pandemic levels of employment in housing, which I think is significant for economic modeling going forward.
We had a big surge in wage growth in 2021, and I think the drivers were, number one, the very tight labor market. My favorite measure of the different ones I discussed is the jobs workers gap, the difference between job openings and unemployed workers. That was at an all-time high of plus 6 million, a ratio of job openings to unemployed workers of almost 2 to 1. Great indicator of a super tight labor market. So that put upward pressure on wage growth. And then in addition, there was the impact of the big increases in headline inflation on wage demand. So the first really was driving real wage aspirations. The second was driving how that translated into nominal wage growth. But both of those factors are reversing and have reversed to a significant degree. And so that's why wage growth has fallen by about 1.5 percentage points so far, and why I think it has another roughly 1 percentage point to fall. So I think we'll get back down to the 3.5% range.
And what are your thoughts on layoffs? Yeah.
Layoffs continue to be very low. The labor market is adjusting via reduced hiring and not via increases in layoffs. In our forecast, the unemployment rate stays roughly where it is for the next couple of years. That's been our view and continues to be our view. And I think we don't get a big layoff wave, and I would expect, initial jobless claims to stay in sort of the low 200,000s, which is where we've been for most of the last year.
Gennaro, do you have any thoughts on this?
No, I basically agree with Jan. And actually, the wage growth was mainly to compensate the increase in prices. So I think that this has now more or less accomplished its role. So I expect this to stabilize, real wages to stabilize.
Okay, and we have another question from Mark for Christopher. This is an interesting question. Which banks in general are more vulnerable, community banks or regional banks?
Well, it's funny, the narrative has focused on smaller banks, and yes, they do have small commercial exposures, but the numbers in terms of just overall exposure are much higher at the large banks. The comparisons are not easy because half of JP Morgan, for example, is not bank, it's investments. So when you look at the ratios, you might conclude that large banks are in better shape because of the ratios versus total assets. Less than half of Bank of America is bank. So they tend to look better, but I would tell you that they have very large idiosyncratic exposures in large urban commercial real estate. Now, again, look at New York Community Bank if you want an example. They're going to have to work out a lot of properties, and this will take years. This is going to look like the oil patch in Texas in the 1970s. You should ask Jamie about that, because it's unanticipated. And in fact, I would say to the next panel, when you talk about industrial policy, I think the industrial policy we need desperately goes back to the 1930s, the Reconstruction Finance Corp, simply to help cities restructure moribund commercial real estate. You know, what are we going to do with 3rd Avenue in New York City from the 50s down to the 30s? Those buildings are all half utilized, if that.
And just there is another specific question for you about this topic of commercial real estate. This is from Abdul. How do you explain the fact of extensive building and road construction in the city of Madison, Wisconsin? Don't know if you have an answer for that.
Well, look, again, real estate is a local analysis. You cannot get out the roller and just start painting. It's the biggest mistake you can make analytically. You could have a property that's an A property that's doing fine, that's cash flowing, fully let, good valuation, right next door to a building that's going to be sold at half of the last price. So that's why it's so difficult to generalize about commercial. Some communities are great. I'll give you a funny example. I went to Villanova. King of Prussia Mall out west of Philadelphia, right? Fully let, doing great. The people in Philadelphia love going to the mall. So that property is doing outstanding. But you can find other properties very close by that are back on their heels. And that's why I think this is going to take years to work out. The banks will obviously slow walk these problems. They'll try and work with the borrower if they can. And if not, then they'll have to resolve it. But the politicians, Harriet, will be standing right there, and they will be part of the conversation.
Yeah, that's an interesting point. Actually, I can confirm that near where I live, close to Annapolis, there are some malls that are empty, completely derelict, right next to malls that have just been built and are full of shops and bustling. It's a very confusing situation.
Every time you build a new mall in Florida, the one down the road that's 10 or 15 years old, it's fine. And now all of a sudden the property's valuation's been cut in half. So.
Yeah, it's an unusual situation. Just to go to a question from Howard, this is about fiscal spending and whether we are downplaying the risks of fiscal spending. Howard says Republicans are complaining of deficits, but might have to argue to keep tax rates. And he also says corporate taxes might go up under Biden. Let's hear your thoughts on that. Fiscal spending, are we underplaying the risk?
Underplaying. So I do think that the federal deficit is at a problematic level. I didn't think that post the 2008 crisis and that recession, because I think back then we had a large deficit that was largely the flip side of an underemployed economy. Now we have a federal deficit of 6 to 7% of GDP with an unemployment rate of 3.8%. I think that is going to have to be addressed in the medium term. I wouldn't expect a crisis in the shorter term, and I think the most likely outcome is that a large deficit will continue to keep real rates higher than they otherwise would be without a crisis-like development. But I do think that we will need to see a fiscal adjustment down the road.
Harriet, I follow the Treasury market very closely. The policy really before Janet Yellen of front-loading everything in the market in the T-bills is a mistake. We should have approached the management of the federal debt in a very different way. So now here we are. We actually have a shortage of collateral at the moment, and the Treasury intends to do all the refundings this year, mostly in T-bills, which I think is suicidal. But, that's the way we've been managing Treasury for a long time.
But I have a contrarian view. As I said in my presentation, I don't see why the U.S. government should have a problem in refinancing the debt which comes to maturity, unless it clashes with the Fed.
Okay, and I just want to remind everyone who is participating at the moment that if you do have a question for our panelists, just put them in the Q&A, and we'll try and get everything answered in the roughly 15 minutes that we have left of our discussion. So we have another question. This came up when Jan was giving his presentation. You did address this slightly, but somebody apparently wants some more specificity. How many rate cuts do you see in 2024?
We have two. We have a cut in July and a cut in November in our baseline.
I think you'll be lucky to have one, Harriet. You already just had one by slowing the runoff of the balance sheet. So that's a cut. And reserves are growing, which is what the Fed cares about. You know, reserves and bank deposits, unfortunately, interact very badly with Treasury's cash management activities. So what do we worry about? The back and forth between reserves on the one hand and the Treasury general account, which can get up close to $1 trillion when they're done with the refunding.
Gennaro, how many rate cuts do you have in your forecast?
No, this is not out of my
Oh,
understanding.
come on, Gennaro.
I think they are not going to cut very soon.
Oh.
So from what I read on the New York Times yesterday. But it will depend. And also there is this argument that if they cut before the elections, they may be seen as making a political move, so they will not want to do that. So there are motivations which are not strictly economic, and therefore get out of my area of competence.
Harriet, I think the real issue is Fed will cut short-term rates, but what happens on the long end? I'd love to hear Jan talk about that. Because, you know, my lenders will make more money if we cut Fed funds. Their warehouse costs will go down. But where will long-term mortgage rates be? Because we price off the 10-year.
I mean, I would expect long-term rates to come down somewhat as well, basically because I think the last three inflation reports are going to give way to a more, friendly picture in the next three inflation reports. And I think that is one really key driver of what the Fed does. And my forecast of a July cut does assume much friendlier inflation numbers in the next 3 months. If the numbers don't get much friendlier, then they're going to push it back further. I mean, that's pretty clear from the signaling and the press conference that Chair Powell gave yesterday. I think in the sort of environment that I'm outlining, there is some downside for 10-year yields as well. Right now we're at 460. I think in a more sort of steady state environment, I would expect to be more in the 4.25% range rather than 4.6% range. The way I get there is to assume that the longer term equilibrium rate for the funds rate is something in the 3.5% range, and then add a 75 basis point term premium to that. There's a range of uncertainty around that, but that would be my baseline view.
We have another interesting question. This is probably a question that every single central banker in the world is thinking about right now. Is there a debate that high interest rates will cure inflation?
Well, I think higher interest rates, all else equal, translate into tighter financial conditions and therefore translate into a hit to demand growth that is bigger than whatever hit to supply growth you might get. So I do think that basic logic is correct, that you can bring down inflation through that channel. Now, how reliable that channel is and how large the effects are, that's, I think, much more debatable. But directionally, I do think that is the primary instrument that central bankers have. And in my view, it's much more about the level of the policy rate than the size of the balance sheet. I mean, I think outside exceptional situations such as the zero rate environment of the post-2008 period, the balance sheet, I don't think matters nearly as much as the instrument that central banks directly control, which is short-term rates.
Harry, you're certainly going to see financial inflation. In other words, the inflation in commercial real estate that we saw after COVID, which was driven by low rates. So when leverage is free, sure, let's go out and buy some assets. But if you look today, leverage doesn't help you. I'm working on an ETF for bank preferreds and common and debt. We're not going to put leverage under it. Doesn't make any sense. So that component, compared to say 5 years ago, is off the table now. And bankers have to go out and make money the old-fashioned way. We can't just use leverage, you know.
Well, as far as I know, there is a strong debate on whether higher rates will cure inflation, because in old textbooks, the idea was that of the Phillips curve. So you increase the unemployment rate, the pressure on nominal wages went down, inflation went down. But first of all, the Phillips curve is no longer there in the data, and therefore it's not so clear that higher unemployment rate will imply lower inflation rates. And moreover, the recent inflation episode came from abroad, came from energy prices, prices of some raw materials, price of transportation, but not from wages. So increasing the unemployment rate is not the obvious reply, because the request from workers was not the main cause of inflation. So given this, the response of prices to high interest rate may be very low, but fortunately, the real determinants of inflation, which was foreign prices and energy prices, are going down. We hope they will even go down even faster if the wars end, which is what we all hope for. So central banks may not be crucial on inflation at this round. Obviously, there are other effects of interest rates on income distribution, on financial markets, etc.
What about the risk of stagflation? I'm just curious, because this is something that I hear about a lot, and readers seem to be very concerned about, especially at the moment when we've seen this slight uptick in inflation early in this year. Do you think there's a meaningful risk that we could get into a stagflationary environment?
You know, I think we're headed there now, Harriet. Think about going back to Alan Greenspan. We have dropped interest rates steadily to goose nominal growth. What if the Fed cuts rates a couple times and leaves Fed funds at 4 or 4.5, which will take pressure off dealers, but then the fun is over, right? We're not going to have that cyclical up and down in interest rates to drive nominal growth. A lot of people might say that would be a superior scenario, but the growth will definitely not look like what we're used to. Definitely not. You know, think of housing. Imagine if home prices were flat and prices for commercial real estate were flat over the next 10, 20 years. That would change behavior from investors dramatically.
I'm with Chair Powell on this. I don't see the stag. I don't see deflation in my forecast. Growth continues at 2.5% pace, you know, ultimately probably converging to something a little bit lower. Inflation gets back to 2%. That's nowhere close to a stagflationary environment, in my view.
We need more for commercial real estate, Jan. 2 is not enough. You got to get us 5 to 10.
Certainly, deflation is out of the picture, because deflation, as I see it, comes from a decline in nominal wages that was achieved in Greece, for instance, in its recent crisis. But other than that, the continuous fall in prices either comes with a continuous fall in wages, which may not be politically sustainable, or it's not going to last for long.
We got to bring Irving Fisher back into this conversation. We have debt deflation in commercial real estate right now. You don't see it because this is on the books of banks and REITs, and these are professionals. These aren't consumers. So you don't hear about it. You read about it in the paper when it's resolved. So believe me, we're going to destroy a lot of value this year. And the government may need to get involved to help finance the recuperation of some of these cities.
Okay, watch this space.
Oh, yeah.
We unfortunately, I don't think we're going to get to all the questions, but there is a very interesting question, I think, that everyone would probably want to know from all three of you. What is the one thing that keeps you up at night with regards to our current financial outlook? I think we can probably guess what's keeping Christopher up at night, but go ahead and tell us.
Treasury auctions. That's it.
Sorry, did you say press reactions?
No, Treasury
auctions. I'm sorry,
yeah.
Treasury auctions.
Yes, the bid to cover ratio. That's all we want to know. Because I work with lenders. What do they want to know? When are rates falling? So,
look, I have a generally fairly constructive view, but I'm much less worried about financial instability in the economy than I was in the run up to the 2008 period, when you had an absence of significant shocks to a large extent for a few decades, and strong economic performance, but building imbalances in the economy. The private sector financial balance, which I know is near and dear to your hearts at the Levy Institute, I was very, very concerned about. Since the GFC, I've been, much more constructive on the sort of fundamental stability of the financial system. I think that's generally proven to be the right place to be. If I look, for example, at what happened in early 2023, we did have a lot of worries about a major financial disruption after Silicon Valley Bank and Signature Bank, but the system held up very well. I am more worried about the more exogenous shocks from geopolitics and politics. I mean, those have really been much greater, and the risk of more shocks is very significant. Right now, I'm giving a probability that the U.S. economy is going to go into a recession in the next 12 months of 15%, which is well below the consensus view. Still, I think the latest numbers are about 30% from the Wall Street Journal and from Bloomberg. But 15% is, most of that 15% is taken up by, exogenous shocks or less, more political and geopolitical shocks. So that's what I'm most worried about.
I completely endorse Jan's response. I'm not very concerned about financial crisis right now, but very much by geopolitical tensions.
Okay, well, we are at time now, and everyone, thank you so much for being on the panel today. This has been extremely informative and interesting, and thank you also to all the participants for your questions, for your excellent questions. We're going to take a 15-minute break now, and then we will be back here at noon for session 2, which is on the revival of industrial policy. So thank you, everyone, for being here,
Thank you, Harriet.
Enjoy your break.
Thank you so much.
Thank
Bye.
you.